Alrighty then, let's get started. Welcome one and all. Wow, look how many people are logged in. This is great. This is great. My name is Adam Rosen. I am the CEO of ForexLounge.com. I'm going to give you a little more information about that in a little while. But I'd like to start off by thanking FX Street for hosting our show today. Always a pleasure. Today's hour, or a little less than an hour, minus my setup time, will be discussing spotting short-term reversal points in the foreign exchange market. These techniques can be used in many different markets, in the stock markets, commodities, but we're going to focus our attention today to the foreign exchange market. There are a lot of really tremendous examples, long-term, short-term. You know, the title says short-term reversal points, but, you know, to be quite honest with you, this can be used on a long and short-term basis. So we're going to jump right to it. If you have any questions at all, please do not hesitate. Chat them right in. There's about 1 million subscribers logged into this room, so I will try my best to get to everyone. Please don't be insulted if I don't. I'm a fast reader, though. So, okay, let's get started. What is a short-term or forget short-term, what's a reversal point? Obviously, when the market has moved up, or down, and decides to reverse direction. Well, wouldn't we love to be able to buy low and sell high, just like the commercial says again and again, right? Well, typically, we tell our traders on ForexLounge.com that we should try to stick with the major direction of the trend. Okay, so if the dollar Canada, for example, is moving down, I only want to sell shorts. Puts the wind of the trend, or the strength of the trend, in our favor. If the euro dollar is going up, it appears it never will stop going up, then I only want to go long. Well, if I want to go long the euro dollar or short the dollar CAD, I want to buy as low as possible or sell as high as possible. Now, with that rationale, if you follow that, well, we're going to find ourselves trying to buy the euro when it's going down. Long-term chart says up, short-term chart says down. Okay? I'll give you some really good charting examples, so please don't get nervous if you don't understand exactly what we're talking about. I'm going to show you right now, okay? The first chart we're looking at, and once again, please, if you cannot see the charts, or if you'd like me to refresh them, do not hesitate, let me know. I just have to click a refresh button over here, alrighty? So don't be shy. I know you won't be. Alrighty, wow, look at all these people. Wow, I love it. Okay, crude oil, 4-hour charts. Futures, currently 97.47, okay? This is a very typical reversal point over here. We call this a double top pattern. A double top pattern is when the market touches a certain price level twice and then falls back down. Do you folks see two charts? You should only see the crude oil chart. I just want to make sure, with a double top pattern right over here. Is that what you folks see? You see two charts. Only one chart? I see all these yeses and nos. Please. What's that? Close the extra chart. Okay. All right, beautiful. Oh, you scared me. Everybody was typing in yes, no, yes, no, yes, no. I said, yes for what? No, I have to ask more specific questions, I think. Thank you very much, though. Alrighty. Now, the double top pattern, we should be only seeing the crude oil with a double top, where the mouse is moving right now. If you have any other charts, please close the other chart, other than the double top pattern that we're seeing over here. Okay, now what we're looking at is crude oil that touched about $97, $98, a little bit, actually about $99, a little bit of a higher high twice, and then reverse direction. We also see very often double bottom patterns, where the market will hit a major double bottom and then reverse direction to the upside. Okay? I'll throw on an indicator now. We call them oscillators. An oscillator is nothing more than an indicator that measures the market's upward or downward movements. Okay? If you have two images, please close one of them You should be looking at only the crude oil chart with the double top, and I have the MACD indicator plotted below, and I have the mouse moving over here. So the chart with the mouse moving, you can leave open. That's one we're on right now. And the other one, if you have another one, please close that. Technology. Always on our side, right? Alrighty. So what happens is the market tests this price level twice and then reverses direction. Now, how come we can't have a single top? I love it. He's in every, I hope it's a he. I'm sorry, she. I'm not sure. It's so hard to tell. He's in every single one of my webinars, every week, loyally. I love it. A double top pattern occurs when the market touches touches a double top twice, or the price level twice. Now, a triple top occurs when the same thing happens 3 times. Now, how do we know if this is just another top before the market goes higher or a potential reversal point? Well, one way, we throw in the MACD, M-A-C-D, Moving Average Convergence Divergence. Simply measures the relationship between the 12 and 26 exponential moving averages. Okay? Now, what happens is, notice, during the first top of the double top, we see the MACD was a relatively high position, right around here. The second double top was a little bit higher. First double top was 97.50. The second high was on 99. It was actually 71 cents off of $100 a barrel on crude oil. That was reported on Bloomberg last night. But notice, even though, despite the market making a higher high, the MACD made a lower high. This is called divergence or disagreement. It's a very common and very powerful tool in the foreign exchange market, as well as other markets, but more so in the foreign exchange market. More volume translates to more consistent chart patterns, more consistent trading signals, okay? So we see over here, when the market makes a double top or even a little bit of a higher high, and the MACD makes a lower high, beautiful, divergence, then we choose to sell short with our protective stops placed above the highs with the anticipation for the market to reverse back to the downside. That's a very, very simple example. Now, I'm going to look at euro dollar. Can you folks see the euro dollar now? It should be euro dollar chart with the Bollinger Bands. Can you folks see that okay? If not, I will just refresh my charts. All right, I refresh them. All right. Beautiful. Okay. Now we have the euro dollar 1 hour charts. We see here where I place my mouse. The market touched the upper Bollinger Band. Now, Bollinger Bands simply are the 20 simple moving average, which is that center line. That's all it is. 20 simple moving average plotted 2 standard deviations above and below this moving average. Standard deviations, for those of you who have not taken statistics in a while, I haven't, simply measures the market's current volatility, okay? And over the past 20 trading periods on a 1 hour chart, 20 hours, it will measure 2 standard deviations. 2 standard deviations, for those of you who are not math majors, like myself, simply measure or intend to measure a 95% of the market's volatility, or 95% of the market's trading action statistically should occur between the upper and lower Bollinger Bands. About 2.5% of the time, the market will travel above the upper band, and 2.5% of the time, the market will travel below the lower band. May not always look that way on a chart, but statistically, that's 2 standard deviations. Now, what we want to do, therefore, is look for cases where the market goes above the upper band to sell short, over here, or to go long below the lower band. But you may see, well, you may ask me, well, Adam, you're partially right. However, look how the market exploded above the upper band, and we would have, if we had sold short, we would have lost money dearly. Well, here's the key. This is how we filter out those bad trades. We want to look again for a double top or close to a double top. Notice over here, this high, the market establishes a double top above the upper Bollinger Band. Great. Signal number 1 is on. Now we know the market has moved exponentially to the upside. Now what we're looking for is a case where the market can return to the recent highs and possibly touch the upper band but not make new highs, or make new highs and not cross above the upper band. You see, when the market goes above the upper band and establishes a new high, it's very bullish. It's very indicative that the market will continue higher. But when the market fails to do one or the other, when it fails to go above the upper band, or it fails to make a new high, at that point we say to ourselves, great, now there's divergence. The market's telling me in this case, yeah, we were able to almost nearly, within about 2 pips, close enough for me, 2 pips, touch the upper band, but we failed to make a new high. There is not enough evidence of a continuation, and therefore enough evidence of a reversal. Now let's follow the rationale down. We see the market goes below the lower band and a new low. I don't want to buy. Too strong to the downside. The market recovers, comes back down, makes a new low. If we were to zoom in this chart, we'll see after a period of time, the market recovers, and you see over here, in this case, the market goes below the lower band, but fails to make a new low. Now we did not solve, or we did not satisfy both of our criteria. Yeah, we're below the lower band, but we didn't make a new market low. Therefore, good. Let's cover our short position. We made money on that, and we can even go long with stops placed below the recent lows. Now, the market gets parabolic, flies to new highs. Well, we don't do anything. We hold on happily as we're long and we're enjoying the ride. But notice over here, I'm going to zoom in one time frame for you. There's a 1 hour chart, and we see here, very, very nice, a triple top pattern at 148, 148.50. Now I know the third top did not exactly touch the 148.50 level. This is euro dollar, but it's not always going to be the case. Charting, like it or not, is a little bit of an art of approximation. You know, we are measuring $3.2 billion that travels through the foreign exchange market every day. About half of that volume actually goes through the euro-dollar pair, if you can believe that. So with that said, you know, you're going to get pretty consistent chart patterns, but they're not going to be exact, okay? They're not going to be exact all the time. We have to give ourselves a little bit of leeway, okay? If I'm going too fast, I do apologize. Please let me know. I'll be more than happy to go over any concepts. There's so much stuff to cover, though, and so little time. So I want to just jump right to the next point. Okay? Oh, yeah, finally. So we're following a euro-dollar trade. We have a triple top pattern. We see at one point the market touches the upper Bollinger Band, but fails to cross above. Now we know, well, the market's making a double top, possibly a triple top, 148.50. We're touching the upper band, but we're not making new highs. Great. You know what? Let's book in our profits. We made a ton of money, about 200 pips in that trade. We'll close the position, possibly even go short if you choose to do so, and wait for a better point to reverse course. Now we see the market touches a lower Bollinger Band and then fails to make a new low. Now you say, well, yeah, it made a new low for the past 4 or 5 candles. This is another area of a little bit of subjectivity. But we see also at 147.75, the market touched the recent lows that were established the previous day. Does everybody see how that works? So you want to basically visually count how many candlesticks back do I have to look for the market to make a new low or new high. That's why when, you know, during our market broadcasts on ForexLounge.com, you know, we're on the dollar-yen and we're counting back months, years, to see when the dollar-yen has been this low. On the dollar-Swissy, I don't think our charts go back that far. We're counting back decades. Same holds true, obviously, with the euro-dollar, new contract high. So it's important to count how many, just, you know, a guesstimate, a rough idea. How long ago do we have to look in the past for the market to have made a new high or new low? Okay? The next chart we're looking at, let me refresh. Excellent. Dollar CAD. Here is another excellent example of reversal. Okay? Dollar CAD, 4-hour chart, trending to the downside. I drew one simple resistance line. Resistance is simply established by connecting at least 2 significant high points. Okay? Traders selling short in the same direction as the overall trend will continue to try to sell short near resistance. They'll place their stops above resistance, and they'll take profit when the market pulls back down below to its recent lows. Okay? Now, this is another great way to spot a reversal. In a downtrending market, focus on resistance. In an uptrending market, focus on supports. Why? Because support and resistance tell us the strength or the weakness of the buyers or sellers at hand. I just drew now a current support level. I fundamentally am very bearish in dollar CAD. I think the dollar trend continues to go down. I think oil just a hair below $100 a barrel definitely benefits the Canadian dollar. You know, some may argue, yeah, well, the CPI was a little less than expected recently. I think the price of oil outweighs the CPI's effect. However, well, that's on another show. But fundamentally, I think that because of the downtrend in the dollar and the high oil prices that the Canadian dollar benefits from, I think the dollar CAD will reverse soon back to the downside. Blank screen, huh? All right. How does that look? That any better on the dollar CAD? You should see a downtrending resistance, uptrending support now. Excellent, excellent. Oh, great. Scared me for a second. Thank you, Boyke. So, with the dollar CAD, fundamentally, I love it to the downside, but so far, I don't want to sell shorts. Because at 98.93, current price of the dollar CAD, like it or not, we're still above this uptrending support level. Who knows how far this may go? I think it stops soon, but that's my opinion. The market, as we well know, does not have to agree with me all the time. And oftentimes it does not. But that's what makes up the market, varying opinions, buyers and sellers. Now, in addition to our support and resistance lines, I have below here an RSI indicator. It's one of the first indicators I was ever taught to use, one of my favorites, I think one of the easiest. RSI, Relative Strength Index. It goes back 14 periods. There's a 4-hour chart, so 14 4-hour candles going back. And it calculates the relative strength of the market compared to those 14 trading candles. Okay? It's plotted on a scale of 0 to 100. Indications above 70 are considered quote-unquote overbought. Indications below 30 are considered quote-unquote oversold. Now, what's the real signal? When the market crosses below 30 and then back up above 30. That oversold market, just because it's oversold doesn't mean it can't go down more. In fact, notice, the RSI actually crossed below 30 on the way down, and the market continued to fall to new lows. So how do we know when really the RSI reversal is the best chance to buy? Well, I'll tell you something. Look at the angle. Look at the angle. Note the angle of the RSI line. Notice during its true reversal, it shot up almost vertically. Again, it's a little bit of a subjective art. But we can see over here, the RSI reached its lowest point and then almost went vertical to the upside. What this shows is this. As the dollar CAD is going down, the sellers are dominating the world in terms of the dollar CAD world. They're selling dollars, they're buying CAD, they're selling dollars, buying CAD, they're selling dollars, buying CAD. That's all we know, okay? Eventually, you picture, let's say there's 100 buyers and sellers in a room, and 85 or 90 of them are sellers. And only, well, maybe 10 or 15 are buyers. Well, every time we go down, the buyers get squeezed out, and the sellers make more money, and the buyers get stopped out, and the sellers sell more. Eventually, when you've got 98, 99 people in a room, all sellers, 2 are buyers, well, yeah, eventually the buyers get squeezed out, but then we have a room full of traders who are sold shorts, who are all shorts. The first moment the market upticks, the trader with the shortest stop or the smallest amount of margin gets stopped out. That pushes the market up a little bit. Then maybe somebody sees that little buying action, says, hey, I'll buy a little. That triggers another stop. All of a sudden, you have all these shorts running out of the room and trying to cover the short trades, and some of them probably trying to go long the dollar CAD. And that's why reversals after such a long trend are so fast and furious, because of the fact that most of the traders are on the short side, or most of the traders are on the long side. And that creates that almost vertical line on the dollar CAD to the upside. Okay? Now, in addition to that, we broke above our downtrending resistance line. There's a very, very important precedent when it comes to trading that if our resistance is broken, it may become our new support level as well. Show you what I mean. This was our resistance. We touched it a few times, just around 9,400 on dollar CAD. Well, if we were to zoom in, we could see the market actually tested this and showed us a new support level. Picture it this way. I love this analogy. You're standing in your kitchen in your New York City apartment on the Lower East Side. Your 5th floor walk up, which means no elevator. You climb up and down the stairs 5 times a day, 5 flights each time. And all of a sudden, because the building is 100 years old, you fall through the kitchen floor. The next thing you know, you're standing in your neighbor's kitchen on the 4th floor, and your previous floor now becomes your new ceiling. The opposite holds true, that if you go up through your ceiling, your old ceiling becomes your new floor. So 9,400, which was once, if you see over here, the market held a small support level on a 4-hour chart, broke down, it became our new resistance. New resistance was finally broken, it became our new support, which began to trend to the upside. Okay? So just some food for thought. Now, the same holds true the RSI in selling short. We want to look for places where not opportunities, but occasions where the RSI goes above 70 and then back below 70. We also want to make sure that the market is not making new highs. I'll zoom in on a 1-hour chart and give you a better idea of what this looks like. All right? We see here, double top pattern, 1-hour chart. The RSI was above 70 and crossed back below 70. Great. Now what do we see over here? This is very, very timely example. The market is back above the highest high, about 9,900, but the RSI is failing to follow suit. The RSI is still below 70. This makes me feel more comfortable selling short the dollar CAD because the RSI is not above 70. However, this is not a foolproof technique. None of these are. And we should always use protective stops above the recent highs. But statistically, and we can use this the same way we use our Bollinger Bands, where we're looking for both cases to occur, where the market makes a new high while the RSI is above 70, or the market makes a new low while the RSI is below 30. We're looking for both elements to occur around the same time in order to really filter out those trades that have the best chance of making money and those which do not. Alrighty? Next charts. Let me refresh. This next chart here is a very, very common pattern. But I have noticed through our work at Forex Lounge, it has been so common as of late. It would be not fair if I did not mention it. So I will mention it. It probably is a little bit of a review for some of you. I apologize, but I need to review as well. So we'll go quickly. This is a cable yen daily chart, pound yen. What we're looking at over here is known as a head and shoulders pattern. Okay? A head and shoulders pattern is simply this, a triple top pattern where the highest high, or the center high of the triple top, you see 1, 2, 3. The center high is higher than the first or the third high. The first and the third high in a triple top are called the shoulders. The top, the highest high is considered the head. So you picture this, we're looking at a picture of a silhouette of a person, and we say, well, the first shoulder at the cable yen was at 241.55. The second high, the highest high, was the head at 251, nearly 1,000 pips higher. Unbelievable. Now, the third high is the second shoulder, and the rule of thumb in head and shoulders is that the first and second shoulder, the second shoulder should rally just about to the point of the first shoulder. Now, I'm going to tell you something. I don't have the exact figures with me. I'm going to try to find them really quick. The first high is 241.48. Somebody write that down. 241.48 is the first high of the shoulder, the high of the first shoulder. Now, the rule is the second shoulder should be more or less as high as the first shoulder. No chart, huh? How about that? Is that any better? The second shoulder should fall just about to the high of the first shoulder. So, we see the first high, what did we say? 241.48. The second shoulder, 241.37. 11 pips. This amazes me. Keep in mind, the first shoulder, no chart, huh? FX Street, what's going on over here? The first shoulder established highs January of 2007. Nearly 10, 11 months later, the market doesn't follow the rules of head and shoulders. The market just trades according to buyers and sellers. Came within 11 pips of the former high, meaning the first and second shoulders were 11 pips different. 10 months later. That to me is absolutely amazing. Now, in trading ahead and shoulders, we also want to establish our neckline. Our neckline is the bottom of our trading range during the head and shoulders. That's actually the shoulder line, so to speak. Now, what happens is we only know the head and shoulders will really complete itself and fulfill itself once it breaks below the neckline. Once that occurs, look out, because the distance from the neckline to the head could be also the distance of our new breakdown to the downside. Long story short, in terms of the cable yen, it's very feasible that if we break 220 to 218, the neckline of the cable yen, we could see another 2,000 pips to the downside. It could happen very, very quickly too. Okay? Does that make perfect sense? I want to mention it because it really is, it's the head and shoulders, we see these all the time. There is, of course, called a reverse head and shoulders as well, where it's a triple bottom pattern. Just take this chart and flip it upside down. So where the lowest low is lower than the two shoulders. Okay? I want to show you another example. Here's Aussie dollar. I'm going to refresh my charts here. Aussie dollar. Aussie dollar. This is a 1 hour chart. This is actually a very good example of a short-term head and shoulders 1 hour chart. We see the first shoulder where my mouse is around 89.20. 89.20, first chart, first shoulder. The head was established about 89.50, higher high. Now, true, the market on the third attempt was not able to exactly come back of 89.20, but the message still remains the same. As that famous song, the song remains the same. The message is still the same. Even though the market was not able to retest a second shoulder near the high of the first shoulder, we hope it will, but this is actually more of a bearish sign, more of a negative sign. We're saying now, hey, the buyers during the first shoulder took us all the way up. The buyers during the head took us a little bit higher. But now, after even a higher high, we came all the way back down. That's not good. That's not good. Uptrending markets make higher highs and higher lows. Downtrending markets make lower highs and lower lows. Now the market came all the way back down to 88 and change, 88.30. Then we failed to even break the 89 figure. Now the buyers just say, I give up. Let's call it a day. Pack up the bids. We're going home. We're going to have a picnic. And this is what happens. Then the market crashes below and falls to new lows. Is it coincidence that patterns repeats? No, I don't think so at all. I mean, the patterns, it's a great question. The patterns occur, you know, I listened to the last 10 seconds of the previous speaker, and he made a very, very good point. I really don't know his name, but he made a very good point. He said that the charts simply reflect the psychological habits of the market. I mean, at the end of the day, the market is made up of us. Everyone logged into FX Street. Every single one of us that has a foreign exchange account somewhere out there, or at the foreign exchange market, it's literally every single person on the planet. You know, because every single, you know, not all of us own stock, but all of us own currency, whatever currency is in your wallet, whether it's euros or pounds or dollars or yen, you know, probably if it's euros or pounds, you're probably a little bit richer now. But the fact of the matter is we're all involved in the currency market one way or the other. So, for me, a New Yorker, Am I going to take a trip to Europe anytime soon? Absolutely not. I would love to. I love Europe. But you know what? I'm staying far, far away from the euro and the $1.48. That's not what I consider a vacation. And you will not find me in London anytime soon whatsoever. However, I got to tell you something. You go to South America, you go to other places with a favorable exchange rate to the U.S. dollar, although that universe is shrinking by the day, that makes a better vacation. Well, my decision as far as where I'm going to take my vacation plays into the foreign exchange market. If I decide to go to Argentina instead of Europe, all the goods and services that I buy in Argentina, because it's a little over 3.1 pesos to the dollar, that will obviously benefit the Argentinian peso, my tiny little contribution to the economy as a tourist. Hardly any Americans in London. I wonder why. I'll tell you something though. You come to New York City, a lot of Europeans. City's gotten a lot better looking over the past few years. I got to tell you that. At any rate, we all play a part in the foreign exchange market. So to get back to your question, it's a great question. Is it a coincidence? I don't believe so. I don't like coincidences. I think that these things happen for a reason, and the very simple explanation is that they reflect the overall sentiment of buyers and sellers. I mean, look, I'm not alone. I'm sure there's not many Americans traveling to London. Well, eventually, that may not affect the pound directly, but you look at those companies within London that service Americans, tourism agencies, they are probably not doing very well. However, the tourist agencies in New York that service European tourists, they're probably doing very, very well. It's very, very obvious. And if you were to look at a price chart of those companies, even easier. Honda and Toyota, both large exporters, both make a lot of their money based on exporting their goods to the U.S. I believe I read like 25 or 30% maybe more. They both reported they're going to miss earnings, or they're lowering their estimates. Honda can't send enough cars to the U.S. Why? Because its exchange rate is killing them. It's not that it's killing Honda, but an American consumer now cannot afford the same Honda that he could a couple of years ago, or Toyota. The opposite holds true, though. For those of you in Europe and you want to take a New Year's vacation in the United States and you want to go shopping, if you're coming from London, New York for you is a 50% sale. So you look at those companies that may service those tourists, and obviously tourism is just a very small example. Importing, exporting, those major capital flows, that really determines, how the charts work. I wanted to give you another example. What was it really quickly? To answer your question, by the way, is this a coincidence? I say no, because we just saw the Aussie dollar. We're looking at right now, 1 hour chart, head and shoulders. Next chart here, Kiwi dollar. I'm going to refresh my charts here. Are they really? Is that true? Tourists from the UK are now going shopping in New York for the weekend? Oh my gosh. This is a Kiwi dollar, New Zealand dollar against the US dollar. And the same pattern, head and shoulders. A little bit more elaborate. This is one of the charts I use for my services, but for the Forex Lounge services. But we have the same type of situation. And both charts reflect the Australian and New Zealand dollars both have a strong tie to the price of gold and the price of precious metals. And price of gold and the chart of gold does not look too hot lately either. Okay? So I don't believe in coincidences. I think that it's very much the case of buyers and sellers, and there's, especially in this market, $3.2 billion a day, I don't think there are any accidents. I think the majority of the capital will show itself on the charts. Why do patterns repeat? Great question. I think the patterns repeat because our behavior repeats. I mean, let me try to find, it's an excellent question. I'm trying to, where is a good example? I have a few minutes left. That's not a good example. Oh, I know what to do. Do not care. Adam's in charge. All right. I know the charts are probably a little bit upside down right now, so bear with me 2 seconds, and I'll give you a nice, fresh picture. Okay. Let me just reload this chart to give you a fresh picture. Okay. What we're looking at right now is a cable yen weekly chart. Pound against the Japanese yen. Pound yen, also known as a carry trade, has been notoriously strong over the past few years. This chart goes back to 1995. The lows that I want to focus in on are down in the 2000 area. Now what happens? British pound, high interest rates. Japanese yen, very low interest rates. Traders, investors, everyone, they buy pounds and they borrow money from Japan to do so. They borrow money from Japan. They only pay 0.5% interest rate right now. They buy the British pound. They get a much better interest rate, and it goes over and over and over again. This behavior of buyers buying higher interest rate yielding pairs or currencies and selling short lower interest rate yielding currencies such as the yen tend to repeat themselves. And then the charts, well, they reflect this repeated behavior. So we draw an uptrending trend line, and we know a support level is drawn by connecting 1 and 2 significant low prices. And this angle of the line simply reflects the amount of buyers versus sellers over X period of time. So, if I had to guess, 3 buyers for every 1 seller over the course of every, trading period on a weekly chart. Let's say every week. 3 buyers versus 1 seller. 3 buyers versus 1 seller. Or you could say another way. For every 3 up days, you have 1 down day. Well, over time, you're going to see a chart develop. Now, if the buyers are more aggressive, you have 4 buyers for every seller, 5 buyers for every seller, the chart will get steeper. Now, what's beautiful about these charts is that what we can do is we can say, hey, where's my resistance? Resistance broken. Remember our ceiling. If we explode through our resistance, oftentimes it become our new supports. And this is the case. This would have picked a very, very nice bottom on cable yen. I'll zoom in one time frame to give you a better idea. Doesn't happen automatically and exactly, but it does give us a very nice rough approximation, okay, as far as cable yen. Okay, really quickly before I run out of time, and if you have any questions, please don't hesitate. I want to mention a few things. The name of my firm, by the way, is forexlounge.com, www.forexlounge.com. And we have a number of different services for traders we've mentioned in the past. We offer 3 daily live market shows. I'm the host. If you like the sound of my voice, I hope you do, you will hear me 3 times a day for an hour and a half every day. We cover the technical picture of the market, the charts, Fibonacci lines, candlestick patterns, all that good stuff. The fundamental side of the market, interest rates, crude oil, gold, Fed speakers, Fed meetings, non-farm payrolls, all this great stuff. We cover all that. Every single day we have a show at 8 o'clock in the morning Eastern, 4 p.m. Eastern, and 2 a.m. Eastern for every single market opening. We also have a brand new fundamental speaker on our list as well, and he has a special 7 p.m. show a few days a week. He gets a lot more in depth with the fundamental picture of the market. In addition, we have live trading signals. We have customized indicators that will measure individual strengths and weaknesses of currencies. Really, really fantastic stuff. A lot more new stuff as well in the very, very near future. But at the minimum, you're going to get a much better idea of how the market works. You're going to feel more comfortable with the chart patterns. You're going to feel more comfortable with the indicators, and you're also going to enjoy it. All of our members really, really love it, and that's why I'm so animated, because our members love it. At any rate, we are running a 1-day special for all of you nice enough to join us in FX Street. Normally the service is around $200 a month. We're offering a very limited sign-up right now for $129 a month. Now the beauty is this. If you subscribe under this promotion, you are guaranteed always to pay only this price. Meaning normally the price for our service is around $200. Here's a link, by the way. This is a link that gives you access to our special promotion of $129. If you sign up under this promotion the next day or so, just basically the next day, you're grandfathered in. You'll never pay more than this price, no matter how high or how many speakers or how many services or how many more indicators we add. Okay, so It's only to your benefit if you are interested. Furthermore, we have a fantastic forum. You do not have to pay for anything for our forum. It's absolutely free. You can visit our forum through our main website, www.forexlounge.com. Lounge.com. I know, I guess I typed that in already. What's your opinion about the V formation candlestick pattern to play short-term reversals? It's a great question. I like candlestick patterns. The V-shaped formation, it's pretty consistent. But you know what? The candlestick patterns on their own, I don't think they're enough. I like to use candlesticks in conjunction with other indicators. Number one, support and resistance lines, like the ones we see here. Number two, Fibonacci. And then, just to add a little bit more spice to our dish over here, throw in one oscillator. Either the RSI, Relative Strength Index, the MACD, Moving Average Convergence Divergence, or the Bollinger Bands. Pick which one you like the best, use one of those, plus support and resistance, and then the candlesticks to fine-tune your trade to pick the exact moment of inflection or the exact reversal point. I think using that approach, you're going to find yourself ignoring a lot of those false trades you may normally take, saving your capital, probably trading a lot less, but I think your percentage win ratio will be a lot better. Okay? Again, we're running special 129 package right now, and we also have a brand new affiliate package where if you recommend a friend, you can actually get our services for free. Okay? If you have any questions, do not hesitate. You can always email us. My private email address is adam@forexlounge.com. And with that said, I'm out of time. I would love to thank everyone for joining us. You guys are a fantastic, gentlemen and ladies, are a fantastic crowd. Thank you very much, FX Street. Please visit FX Street's calendar. I will be on next week again. I thank you very much. Everyone have a great evening or a great morning. All the best. May all your trades be profitable ones. Adam Rosen from Forex Lounge signing off.